Welcome friends, in this video has the countdown started for Xcn coin. We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. Looking carefully at the chart, the prolonged sideways movement and the lack of volume after the bearish breakout are very noticeable. Such movements are often considered as the calm before the storm in technical analysis. In particular, when trading volumes start to decline significantly after a price has fallen to a certain level, it indicates that traders are waiting and avoiding making a clear decision on which way the price will break. But behind this silence, there is a great accumulation of energy. This situation can be thought of as a spring. The longer the squeeze, the harder and faster the possible breakout. When we look at similar patterns in the past, we can see that such periods of volumeless and sideways trading have always been followed by strong price action. Historically, patterns like these tend to repeat themselves, both in terms of technical indicators and price behavior. Therefore, traders should not simply view such squeeze zones as a waste of time, but rather as the footsteps of a big move to come. Because when low volatility and low volume come together, it often indicates that the market can no longer be suppressed any longer and is preparing to break equilibrium. These periods of sideways movement are also very important for investor psychology. During periods of sustained price declines, most traders either walk away from the market because they face losses, or they sell their holdings and wait on the sidelines. The subsequent sideways period is often not attractive enough to open a new position. This is because people generally like to see movement. It is psychologically difficult to take a position without sudden rises or falls. However, professional traders know these sideways periods very well and take positions by anticipating the trend that may occur immediately after these squeezes. So while the smart money slowly accumulates positions during these periods, most retail traders either wait it out or remain indecisive, unable to recover from past losses. Technically, this structure usually indicates an accumulation process. Market participants accumulate positions in this zone, stabilizing their holdings at a certain level. When the price fluctuates within a narrow range, it actually represents a process in which large players are preparing to manipulate the market. Volume may be low because buying and selling are almost equalized. However, it is only when there is a burst of volume in one direction that the expected big breakout begins. This breakout is often triggered either by a breakout of a key technical level or by strong market news. Such rises or falls that follow periods of flatness and lack of volume are usually quite strong. This is because when a stuck price chooses a direction, it's not just a technical break, but also a psychological one. People now perceive a clear trend and quickly start taking positions. This causes the price to accelerate even further. In particular, stop orders accumulated at resistance or support zones can be triggered by these breakouts and rocket the price. We have seen examples of this many times in the past. The price squeezed, the volume decreased, and then came such a violent explosion that most investors were either caught off guard or missed the opportunity. That's why the current situation is not a threat, but an opportunity if interpreted correctly. The market may be sluggish at the moment, but let's not forget that every slump has a potential breakout. The important thing is to take a position before this breakout. That is to be prepared. If this volumeless congestion breaks to the upside, we could see the price accelerate rapidly upwards and experience significant rises in a very short time, similar to its past movements. But we need to look not only at this, but also at other metrics. Stay tuned. One of the most noticeable structures that should not be ignored when we examine the chart is the falling trend line that the price has been moving under for a long time. This trend actually shows that the market in general remains under downward pressure and that buyers are not strong enough. The price has touched this falling trend line on every bullish attempt, but it has always been rejected here and resumed its downward movement. This shows us that this trend line is currently putting serious psychological and technical pressure on the market. However, the situation we are in right now is much more critical and needs to be carefully monitored. Because the price has approached this falling trend line again, and this time the contact may be different from past contacts. Why? Because the overall structure of the market may have started to change. First of all, the recent increase in volumes may indicate that buyers are starting to re-engage and that this falling trend line is no longer viewed as resistance, but as a level that can be breached. Breaking trend lines is one of the most important signals in technical analysis. Because every time the price tests a trend line, the sellers there get a little weaker. Imagine punching a wall over and over again. Each time you hit it, a little more cracks appear, and eventually the wall collapses. Price is actually gaining resistance against sellers every time it tests this falling trend line. And this leaves us with the possibility of a very important breakout. If the price breaks this trend line clearly and voluminously upwards, this is technically considered a trend reversal signal. This means that the decline is over, and the beginning of an uptrend is confirmed. Such breakouts are usually followed by strong price action. This is because a price that stays above the falling trend line builds confidence in investors, which attracts more buyers to the market. In addition, short positions protected by stop-loss orders are triggered, causing the price to move up more quickly. Psychologically, this breakout is also very important, because investors, who have been under pressure for a long time, return to the market with the perception that the decline is over with the break of this trend. This both increases the volume and supports the persistence of the uptrend. However, the breakout also needs to be confirmed in a healthy way. That is, the price should not only break above the trend line, but also hold there and perform a retest. This retest is when the price comes back to the broken trend line and tests it as support. If this level works as support and the price moves back up from here, then we have an extremely strong bullish signal. This is because such retests prove that the market is now firmly moving in a new direction and that buyers are in control. The current structure actually resembles the final stages of a classic downtrend. Throughout the downtrend, each peak was formed lower than the previous one, and the price was constantly making descending highs. However, in recent price action, we can see that this descending peak structure is starting to break down, and the price is reacting more horizontally or upwards. This shows us that the downtrend is starting to weaken. It is also known that big investors, the smart money, take positions before such trend breakouts. This is because in a downtrend, the price is often seen as cheap and it gathers at strong supports. This gives us the following message. A price breakout of this falling trend line is no longer just a possibility, but a necessity. Because unless this breakout happens, the uncertainty in the market will continue, and investors will remain hesitant. But if this breakout does come, it will not only be a technical development, but also a psychological explosion. In conclusion, the picture is quite clear. The price has been under the influence of a downtrend for a long time, and this trend line is about to be tested again. If this time the contact doesn't result in a rejection like in the past, and the price manages to break above this resistance, it would be a very strong technical breakout. With this breakout, it is very likely that the upward movement will accelerate. Therefore, this level should be paid close attention. Developments should be closely monitored, and especially the retest process after the breakout should not be ignored. We have to follow this trend. When we carefully examine the chart, we can clearly see that one of the technical indicators, the ATR, the average true range indicator, has remained at very low levels recently. This clearly indicates that the market is currently going through a very stable process and volatility has been minimized. The ATR actually measures how much the price moves, that is, the range of fluctuations in the market on a daily basis or over a certain period of time. Therefore, a low ATR means that the price is not moving up and down sharply in the short term, but rather is tightly packed within a narrow band. Such low ATR levels are often considered a period of calm in the market. In other words, most traders may have switched to a wait-and-see policy, or price movements are not giving strong enough signals to make a decision. Therefore, the fact that the ATR has fallen to such low levels may indicate that a choice of direction is approaching in the short term. Of course, ATR alone is not enough to clearly predict what that direction will be. However, in combination with other indicators, patterns or trend structures, this narrowing of the ATR can be a very valuable signal. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.